Welcome to the deep dive. Really glad you're here with us today. If you're the kind of person who loves to learn and, wants those crucial aha moments without just drowning in information overload, you're in the right place.
Absolutely. We've got a really fascinating topic today.
We do. We're unpacking two incredible sources today. The first is an article called Indirect Tax in the Age of Continuous Transaction Controls. And the second is this really insightful piece titled The VAT Return is Not Your Biggest Compliance Challenge Anymore.
Yeah, and that title really hits the nail on the head, honestly.
Right. So our mission today is to figure out why the decades-old compliance calendar, this thing companies have relied on forever, is completely collapsing. We're looking at how this new system, continuous transaction controls, or CTC, is basically turning tax compliance from this boring retrospective reporting duty into a high-stakes, real-time architectural challenge.
A challenge that, frankly, can literally stop a business from operating if they get it wrong.
Exactly. It's wild. Okay, let's unpack this. To really grasp the magnitude of this shift, I think we have to look at, think about how a traditional factory works, right? There's this comforting rhythm to it.
Right, the assembly line.
Yeah, the assembly line. The products get built, and at the very end of that line, there's an inspector standing there with a clipboard.
It's a completely isolated retrospective process. The production of the good and the inspection of that good are, fundamentally separate events.
Right, happening at different times. So if a car door has a scratch or, I don't know, a bolt is loose, the inspector pulls it aside. They fix it before it ships.
It's a cleanup job.
It's a cleanup job. But the factory itself never stops running. The conveyor belt just keeps moving. But imagine if instead of standing at the end of the line, that inspector was somehow integrated into every single robotic arm.
Oh, checking every single weld.
Yes. Checking every single bolt the exact millisecond it happens. And if one weld is off by a fraction of a millimeter, the entire assembly line shuts down automatically.
You literally cannot build the next car until you fix that specific machine.
Right.
And that's exactly it. You've moved from a system that allows mistakes and fixes them later to an architecture where mistakes are physically forbidden from occurring in the first place.
It's a massive shift.
It is. And moving from the end of the line to the exact moment of creation, that is the core tension of our sources today. Because for as long as indirect tax functions have existed, dealing with value-added tax across global supply chains, the organizing principle has always been the calendar.
Oh, for sure. The monthly VAT returns, the quarterly intrastat filing.
Well, annual statutory reports.
It was this totally predictable rhythm. Data gets generated by the sales and purchasing teams. It just kind of piles up over the month in the ERP system, and then the tax team steps in.
They were essentially just downstream data reviewers.
Yeah. Exactly. They extract the data, find the missing business partner codes, manually correct whatever formatting is messed up, and just bundle it up for the government right before the deadline hits.
It was purely administrative, just a cleanup job, like you said.
Yeah.
But continuous transaction controls, they dismantle that calendar entirely.
Completely rip it up.
Yeah. CTC frameworks are basically these regulatory models where the government validates business transactions essentially as they happen. And, the variations depend on the jurisdiction.
Right. It's not the same everywhere.
No, not at all. You have pre-clearance models where a government system actually has to validate your digital invoice before you're legally allowed to even send it to your customer.
Wow.
Yeah. Then you have real-time reporting where the data hits the tax authority's API, the application programming interface, the exact moment the invoice is generated. And then there's near real time, which allows a window of maybe a few hours or days.
It's like moving from taking an open book test at the end of the semester to having the teacher look over your shoulder, grading every single keystroke in real time.
That is a perfect analogy.
Yeah.
The test isn't the monthly filing anymore. The test is the keystroke itself.
Which fundamentally alters the stakes, right? I mean, a failure means something completely different now.
Oh, completely. What's fascinating here is that the compliance obligation has entirely shifted off the physical desks of the tax department.
Right, because in the old world, a data quality failure in your financial systems was just like an internal accounting problem. You'd catch it during the month-end close.
Exactly. But under CTC, an integration issue between your invoicing platform and the government portal isn't just some reporting delay. It's an immediate transactional rejection.
The business literally cannot legally issue an invoice.
They can't, which means you can't ship the goods, the supply chain halts, and obviously you cannot collect a payment.
Wow. By the time the tax function sees a transaction now, it's either already succeeded or it has catastrophically failed and blocked a live sale.
Yep. They can no longer just sit downstream and review the data.
But, I mean, let me push back a little here. Are we sure this isn't just a pendulum swing?
How do you mean?
Well, I look at global business leaders facing this, and it sounds like an operational nightmare. Like, governments roll out these heavy-handed regulations, businesses push back because of the friction it causes, and eventually, things soften. Why would governments force such a massive structural transformation on every B2B transaction?
It's a fair question, but to understand why this is permanent, we have to look at the underlying policy problem that governments are desperately trying to solve.
Okay.
That problem is universally known as the VAT gap. It's basically the difference between the tax revenue governments are legally owed based on economic activity and what they actually manage to collect.
And the sources point out the scale of this problem is just staggering. In the European Union alone, this gap historically exceeds $100 billion annually.
Yeah.
Wait, $100 billion with a B?
With a B. Every single year, just vanishing from public coffers.
That is insane. How does that even happen?
Well, that revenue is lost to a combination of things. Simple administrative errors, corporate bankruptcies, but also deliberate, highly sophisticated evasion.
Right, the bad actors.
Exactly. A prime example is missing trader intercommunity fraud, which is often called carousel fraud. Bad actors basically spin up a network of ghost companies, purchase goods across borders tax-free, sell them domestically with VAT included, and then they simply disappear with the collected tax money.
Oh, wow. Long before the annual audit ever happens.
Precisely. They outrun the calendar. The audit cycle is just way too slow to catch high-speed, modern digital evasion.
Yeah, I mean, sending a government auditor to look at a company's books 2 years after the fact is mathematically incapable of closing a gap of that magnitude.
It really is. The volume of global transactions is just too massive, and government enforcement resources are way too limited. Traditional enforcement basically failed.
So CTC changes the enforcement mathematics entirely.
Exactly. By forcing every single invoice to be validated by an automated, government-controlled system at the moment of issuance, you eliminate the opportunity for evasion or error at the source.
The compliance rate isn't enforced by an auditor showing up to your office. It's enforced by the technological architecture itself.
Right. Non-compliant transactions physically cannot be completed.
You literally can't hit send on the fraud.
Nope.
And returning to the sources, there's this striking quote that really puts a nail in the idea of the pendulum swinging back. It says, CTC is not a regulatory experiment. It is the policy response to a fiscal problem that traditional enforcement cannot solve.
And once governments implement these mature CTC frameworks, they see immediate dramatic improvements in compliance rates and revenue collection. The direction of policy globally is entirely set.
Because once governments see that missing 100 billion start flowing into their treasuries without having to hire, thousands of new auditors.
Reversing the policy becomes politically and economically impossible. The weather is completely settled. The only variables left for global organizations to navigate are the specific technical specs and the rollout timings of different countries.
Okay, so if governments aren't backing down, how are companies supposed to survive this, what they call a mandate storm? I mean, if the old way of waiting for the end of the month to fix errors is dead, the tax function has to fundamentally change its operating model.
They do. The sources suggest that tax professionals must transition from being filing managers to being architecture owners.
Architecture owners.
Yes. They have to define the data quality standards that operational systems meet before a transaction is ever posted. This is honestly the most difficult pivot for legacy organizations. Tax must move upstream into the technical infrastructure.
Wait, but how does a tax professional even communicate with a software developer or a systems engineer? I mean, they speak entirely different languages.
Oh, it's a huge challenge.
Right. Like, if I'm an IT architect building out a complex ERP system, I don't necessarily want a tax manager looking over my shoulder dictating how I design my data pipelines. It sounds like a turf war waiting to happen.
It frequently is a turf war initially, I won't lie, but it has to become a shared architectural responsibility. IT owns the code, the servers, the APIs, but tax absolutely must own the logic that dictates what that code actually does.
Interesting.
The sources outline 5 specific new requirements for compliance under CTC, and the foundation of all of them is that tax professionals must be physically present in system design sessions.
Because if the tax logic is wrong in the blueprint, The automated system will just relentlessly generate thousands of compliance failures a second.
Exactly. Let's say a cross-border transaction in a specific country requires a highly specific business partner validation code to be legally valid.
Okay.
If the tax team wasn't in the design session to insist that specific data field be made mandatory for the sales team to fill out in the CRM.
Then the sales rep just leaves the field blank because they're, rushing to close the deal.
Right. And then the system generates the invoice, sends the payload to the government CTC portal via an API, and it's instantly rejected. The failure was built into the system the day it was coded.
Man. Which introduces a secondary problem, really. Tax laws are not static.
Not at all.
Governments tweak rates, they introduce new exemptions, they change data formatting requirements constantly. So even if you design it perfectly on day one, the architecture rots over time unless you have rigorous logic governance.
That continuous governance is critical.
Yeah.
You're basically translating legal prose into machine-readable conditional logic.
Right.
And even with perfect governance, the automated systems will only handle the standard transactions.
Right.
The vast majority of business flows will process seamlessly in the background. But that requires shifting your human tax resources entirely away from routine processing and dedicating them to what the text calls exception intelligence.
Exception intelligence. So what does this all mean? Like, what does this actually look like in practice on a daily basis?
Well, the days of copying and pasting data in spreadsheets to make a Friday deadline are over. The daily grind becomes highly analytical.
Give me an example.
Say the automated system rejects a batch of invoices because a buyer's VAT ID format changed overnight in a specific European jurisdiction. Or maybe a unique supply chain routing triggered an unforeseen tax consequence.
The transaction just halts.
It halts. And the human tax professional doesn't just log in and manually fix that one invoice so the truck can leave the warehouse. They have to act as a diagnostician.
Oh, I see.
They investigate the API error logs, spot the logic gap in the enterprise software, figure out why the automated system failed to handle that edge case, and then rewrite the architectural logic so the system handles it automatically tomorrow.
It's literally detective work.
It is.
You're hunting root causes rather than doing data entry. But, I mean, to even have the luxury of doing that detective work, you need the infrastructure in place.
Yeah.
And governments are rolling these mandates out in aggressive, staggered phases all over the place, Latin America, Europe, Asia.
Yeah, you can't just patch legacy systems 3 months before a country goes live.
Exactly. That brings us to the need for regulatory horizon intelligence. The sources say organizations require a 12 to 36-month view of upcoming mandates across all their operational jurisdictions.
If you treat a new country's CTC mandate as a localized IT project, you will fail. You have to build a flexible, global architectural capability that can adapt to new country requirements as they come online, rather than, scrambling to build bespoke integrations every single time a new country announces a mandate.
And you also need continuous monitoring of your acceptance and rejection rates. You can't wait for a monthly report to tell you that 4% of your invoices in France are failing.
You need a live dashboard showing system health.
But honestly, looking at all of this, the architectural overhaul, the cross-departmental friction, the need to anticipate mandates 3 years out, it sounds like a massive, expensive operational burden.
It certainly is an investment.
Right. It feels like companies are just doing the government's enforcement work for them. Is there a silver lining here?
There absolutely is. If we connect this to the bigger picture, we uncover what is arguably the most underappreciated consequence of the CTC revolution.
Okay, I'm listening.
While governments force this transition to collect tax, they inadvertently force companies to create an absolute goldmine of strategic data.
Because to satisfy the government's real-time transaction controls, you're basically forced to create a comprehensive, perfectly validated, machine-readable record of every single invoice-level financial event your company processes.
Exactly.
Yeah.
And that record has to be flawlessly accurate in real time, otherwise the transaction would have been rejected by the government portal.
Right.
So you are accidentally building the most remarkably rich, granular, and timely financial data asset your organization has ever possessed.
Oh, wow.
And because it's legally mandated for compliance, this pristine data stream is being funded and built, whether the business originally planned to invest in advanced analytics or not.
Which turns this entire narrative on its head. This isn't just about avoiding government fines or keeping the shipping docks moving anymore. You've accidentally built a crystal ball for the CFO.
You really have. If you have a live, second-by-second feed of every transaction globally, The strategic applications are incredible.
Because you instantly have live visibility into your refund and payment positions across all your global entities. I mean, that is massive for treasury operations and cash flow hedging.
It changes the game. You also gain unprecedented transaction-level supply chain intelligence. You know exactly what materials are moving where, the precise moment they're billed, with perfect accuracy.
And you can monitor counterparties too, seeing if the vendors you rely on are maintaining their own legal compliance just based on whether their invoices clear the government portals.
Precisely. None of these are tax outputs. They are massive organizational intelligence assets. Historically, indirect tax was often viewed as a back-office necessity,
Yeah.
a cost center that just kept the company out of trouble.
Yeah, totally.
But the tax leaders who realize the value of this data stream, who capture this live intelligence and route it directly to the chief financial officer or the Treasury Department or the supply chain managers.
They elevate the entire positioning of the tax function.
They do. They transition from being administrators who just file the paperwork to becoming the architects of strategic business intelligence. They hold the live pulse of the company's entire global economic footprint.
That is amazing. So what does this all mean for you listening right now? If your organization is navigating this transition, our sources lay out 5 practical dimensions of operational readiness. Basically, 5 questions you need to ask about your own architecture to see if you are prepared for the end of the calendar.
And they are crucial questions.
Number 1, is your data complete and correct at the source right there in the ERP without needing manual correction by a human later?
That's step one.
Number 2, does your tax team actively own the architecture and the compliance logic, or is IT running the design sessions without tax guidance? Number 3, are you actively monitoring the 12 to 36-month regulatory horizon to build capabilities ahead of the mandates?
You can't fall behind on that.
Definitely not. Number 4, are you extracting that beautiful data intelligence to optimize cash flow, or are you just treating it as regulatory exhaust and throwing it away after you submit it? And number 5, do you have continuous real-time monitoring of your compliance posture, or are you still relying on periodic health checks?
Those 5 questions represent the dividing line between legacy operations and modern resilience. As the text brilliantly anchors this entire discussion, it says, the tax function that is excellent at filing returns is prepared for the world that is ending. The one that is excellent at governing the architecture that keeps every transaction compliant is prepared for the world that is arriving.
Wow. Here's where it gets really interesting, though. I want to leave you with a final thought to mull over. We've established that global governments are successfully forcing businesses to build this technological architecture, right? To validate and monitor every single B2B transaction across the entire economy in real time.
Yep, it's happening.
They are doing this right now just to close the VAT gap. But what happens when these governments realize they now possess a live, perfect economic dashboard of everything happening in their country?
Oh, that's a huge paradigm shift.
Think about the infrastructure. Once those API pipes are built and deeply embedded into every company's billing system, what stops governments from using this exact same real-time transaction data to instantly enforce, say, environmental carbon tracking on supply chains?
Or to monitor material bottlenecks during a crisis as they happen.
Exactly. Or to track inflation instantaneously, product by product, instead of waiting for a sample-based monthly report.
The architecture they're building for tax compliance is the exact foundation required for real-time, algorithmic economic governance.
The inspector isn't just standing at the end of the assembly line anymore. The inspector is everywhere, all at once, monitoring the entire economy. It's wild to think about. Thank you so much for joining us on this deep dive today. We really hope it gave you those aha moments you were looking for. Keep questioning the systems around you, and as always, stay curious.